with Pension Planning Solutions. It's my pleasure to be one of the two presenters, along with Allison Grimm, a co-worker with Pension Planning Solutions. The topic today is greater tax deferral using cash balance plans. This webinar will run approximately 30 minutes. There we go. Just a very brief overview about Pension Planning Solutions. Pension Planning Solutions was incorporated on January the 4th in 1999. We are U.S. Securities and Exchange registered investment advisor firm. Our primary function is to educate boards of directors and retirement plan committees about their fiduciary duties. All of our clients name us as the investment fiduciary, and we have a rigorous process to monitor their investments. We work across all different kinds of qualified plans, including 401k plans, cross-tested plans, also known as new comparability plans, of course cash balance plans, and defined benefit pension plans. This is really just going to be a primer in cash balance plans, and you're going to see our contact information at the end of the webinar. And should you want to go a little bit deeper, please don't hesitate to contact either Allison or myself. Today's agenda is what exactly is a cash balance plan. Allison will be going over a case study, and then I'm going to talk about towards the end who's an ideal candidate, and then review about a half a dozen takeaways for the attendees. Allison will now teach you the basics of cash balance plans.
Good afternoon. As Mike said, I'm Allison Grimm, General Counsel for Pension Planning Solutions. I joined the firm in May of this year after practicing law with a law firm in Greensboro for 19 and a half years, and most of that was in the benefits practice. So I have quite a bit of experience in qualified plans, and that's what we're going to talk about first, is what does it mean for something to be qualified. Qualified plans are tax-favored plans that the IRS allows folks to save into on a tax-favored basis and avoid taxation until the time that they retire, and there are usually favorable tax consequences as well for the company. And there are two broad categories of qualified plans. One is defined contribution plans, which are the ones that are most prevalent these days, and then there are defined benefit plans, which were historically more favorable than they are today. Defined contribution plans are plans that you think about that have account balances, including 401k plans and profit-sharing plans. Defined benefit plans are plans where there is not an account balance and it's a more complicated animal. A cash balance plan is a hybrid. It has some features of each of these two types of plans, but the IRS considers it to be a defined benefit plan. And as we will learn in a few slides later, that is good because it allows us to put more money into a cash balance plan than would otherwise be available if it were a defined contribution plan. So the first thing to think about is, well, how does a cash balance plan differ from a traditional defined benefit plan? Traditional defined benefit plans usually have a complex formula. It will be based on an actuarial calculation, and the benefit is usually stated as the present value of an accrued benefit. The formula usually contains a compensation component and a years of service component, and you have to have an actuary that runs the numbers and tells the company how much money to put into the plan every year. In contrast, cash balance plans have an account balance that looks and feels like a 401k plan, so that each participant can look and see, oh, today I've got $50,000 in my account. So defined benefit plans are unfamiliar. They have archaic terms in them, and they're hard to understand. Cash balance plans are much more familiar because they resemble 401k plans, and people know about those. Defined benefit plans are highly age sensitive. That's because the formula contains years of service and often the actual age of a person in them. Cash balance plans are less age sensitive, although there is an age component, as we'll discuss. We'll next look at the history of the cash balance plan. The very first one was adopted by the Bank of America in 1985. So they've been around a while. But it wasn't until 2001 when the IRS increased the amount of contributions that could be made to these plans in a big way. And so these plans became very attractive, and people started to adopt them. Then in 2006, Congress passed the Pension Protection Act. It provided safe harbors. It provided clarification about how to run these plans and what's proper and what's not. And again, there were increases in the contributions that were allowed into the plans. So they really took off after that. And as of 2009, there were approximately 5,800 cash balance plans in place across the United States. And we believe that that number today is probably over the 6,000 mark. Contribution limits are a big reason why cash balance plans are so attractive in certain instances. If we take a look at a 401k plan, you'll be familiar with the deferral limits that you see in the column that's entitled 401k only. And for people who are under 50 years old, that amount is $16,500 for 2001, and that will go up by $500 to $17,000 for next year. Folks who are over 50 get an additional $5,500 that they can defer each year. That's called a catch-up contribution. So if you look at that, and there's also the ability for employers to make contributions into plans in the form of a profit sharing or perhaps a matching contribution. And so there are limits there. The total amount that can be put into a defined contribution plan for any participant in any year, if the participant is under 50 years old, is $49,000 for 2011, and that will go up to $50,000 for 2012. For participants who are 50 years and older, $54,500 for this year and $55,500 for next year. Okay, so those are big numbers, but there are even bigger numbers that can happen in a cash balance plan. If you look at the cash balance column, contributions can be anywhere from $39,000 for someone aged 30 to 34, all the way up to $193,000 for someone who is aged 60 to 65. So that's a huge number, and the reason is because the cash balance piece is considered a defined benefit plan, and it's not subject to the defined contribution limits. So how do these plans work? Well, let me back up. There is a cash balance lifetime limit, and so the maximum that can be put in the cash balance plan piece is $2.5 million. Now, a participant cannot put that all in 1 year. It must be put in over at least a 10-year period, but it can be socked in pretty heavily in the last few years if the plan design works out that way. Okay, so how do cash balance plans work? Well, in both 401ks and cash balance plans, there are contributions, and the contributions go up, hopefully. In a 401k plan, it goes up, hopefully, by earnings, but sometimes there are losses, as we all know. In cash balance plans, there's a contribution, just like the 401k, but the way the account balance grows is by an interest crediting rate as opposed to earnings. And Mike is going to tell us more about interest crediting rates next.
Thanks, Allison. Okay, the IRS has proposed regs regarding a fair market rate of return. They really have not yet defined it. About 3 weeks ago, it looked like they were going to, and they've pushed back on the final regulations. But they've somewhat provided a range of options, but by far the most popular fair market rate of return used in the cash balance world is the yield on the 30-year Treasury bond. For 2011, it was 4.42%, and we're going to have a new rate as of January 1st. It's going to be based on somewhat of a blended rate for the month of December of this year, but we can virtually guarantee you that it will be lower than 4.42 given the decline in interest rates. The other unique part about cash balance plans is that there are some investment funds created just for them. And the big difference on cash balance plans in regarding the investment strategy you really are looking for a 1-year timeline for that investment strategy, unlike a 401k where the participants can stomach some losses on paper and they're taking a longer view approach. It's totally different for cash balance plans. The top half of this slide, if earnings are higher than the investment crediting rate, then next year's contribution is going to go down. Conversely, the bottom half of this slide, if earnings are lower than the investment crediting rate, next year's contributions are going to have to go up. Now, it can be tempered by amortizing the decline, the underfunding, over a 7-year period. The visuals are, if you look at the bullseye, that would be the investment crediting rate. If the investments come in higher than that, once again, a lower contribution and a smaller tax deduction. And I'll come back to that tax deduction point in about 20 seconds. And then to the bottom half of this slide, if the earnings are too low, and certainly lower than the investment crediting rate, there's going to be a greater expense, larger, in all likelihood, unbudgeted contributions will be required, and there will be some underfunding limitations as it applies to people that separate from service and may desire a lump sum distribution. Okay, here are the key principles of the cash balance plan as it applies to the investments. Principle number 1, preserving the tax deduction is the primary goal. Principle number 2, investments are pooled, not self-directed like in a 401k plan. In fact, they're trustee directed. Principle number 3, unlike 401ks, and Allison touched on this, the plan sponsor bears the investment risk. Principle number 4, the plan must guarantee an annual interest credit, and that number is actually written into the adoption agreement or the plan document. Principle number 5, the interest crediting rate cannot exceed the fair market rate of return, and once again, we're waiting for final regs from the Internal Revenue Service on that. Principle 6 is that the plan assets must be marked to market at year end. So once again, your investment timeline, your goal is to come up with an investment strategy for 1 year. And last, principle 7, overperforming or underperforming the interest crediting rate will result in unfavorable consequences. Okay, Allison will now walk us through a case study.
Thanks, Mike. So it's nice to hear about things in theory, but it's a whole lot easier to understand them if you look at something and actually study it in the form of a case study. So we are going to look at a small business that actually adopted a cash balance plan, and there were 2 owners, one age 62 and one age 41. They both made $245,000 a year, and they had 10 employees ranging in age from 22 to 63 and making anywhere from $14,000 to $89,000. So the question was, what's the best plan for this business if the business is doing well and the owners want to sock away as much money as they can on a tax-favored basis? Well, the starting point is to just look at your basic plan design, which is your 401k plan with the profit-sharing component. And as we'll see here, we have the owners making their maximum contributions, and then a profit-sharing contribution of 5% of pay for everyone. This plan design results in the owners getting $63,000 in contributions to the plan, and the employees getting $23,550. So the total contribution to the plan is $86,550, and of that, 73% goes to the owners. That sounds pretty good, right? Well, other things sound a little bit better. In the last few years, there have been plans that are called either new comparability plans, or sometimes they're called cross-tested plans. And those plans are so named because the IRS will allow you to pass non-discrimination testing in one of 2 ways. You can either compare the contribution rates, or you can compare the benefit rates. And in a new comparability or cross-tested plan, you convert the contributions into benefits and see if you can pass testing that way. And it allows more money to go to older workers than would otherwise be true if you just did it on a contribution basis. So looking at this, you'll see that in a new comparability plan, you can actually pump 13% of pay to the owners and leave the employees only getting 5% of pay. But because of this ability to convert testing, this plan passes the non-discrimination tests, and the owners get $103,500 in contributions. The employees are still at the $23,550, so the total amount of contributions to the plan for the year are $127,050, meaning that the owners get 81% of the total contribution, and that looks pretty good too. If that's enough, if that's all the owners want to do, then you stop here. But lots of times owners want to do more, and this is particularly true where you have professionals or you have folks who maybe have been unable to save in the early years of their work because they're paying back student loans. Maybe they're trying to pay private educations for their children, college for their children, that type of thing. And then they find at some point that all of that's done, and they're making a lot of cash, a lot of money. They're paying a lot of taxes, and they want to be able to maximize their savings and avoid taxes and save more for retirement. In that case, cash balance is a great option. If you look on the right-hand side of this slide, the cash balance range for owner 1 is anywhere from $0 to $225,000. That means that that owner could put as much as $225,000 into the plan each year. Owner 2, because he's younger, can only go from $0 to $60,000. Now you'll notice in the profit sharing column that instead of having the 5% of pay that we had in the previous two examples, that the profit sharing contribution is going to have to be 7.5% of pay. So there is an increased cost if you want to go into a cash balance option in terms of money that you have to pay for your employees. But the principle that we use is to say, how much do you have to give in order to get? And that means, what more do you have to give your employees, and is it worth it to do that in order to get a huge benefit for the owners? Now you'll also see that a nominal amount goes into the cash balance component of the plan for each of the employees, and that's $650. If you compare across the board, you will see that in the cash balance world, the owners can put $279,500 for owner 1, $74,000 for owner 2. The employees will get a total of $41,000, $41,825. So the total amount of money that goes into this plan is $395,000, and 89% of that goes to the owners. That is a huge difference. If you're comparing it back to the 401k plan, there was only $86,500 that went into the plan, and the percentage that the owners got was less. So here, the percentage is high, the dollars are high. So again, the basic plan, we had 73% going to the owners, but it was a low pot of money, about $86,000. In the new comparability, the percentage went up, as did the contributions to the owners, or the total contribution was $127. But in the cash balance, you really, really ramped it up because you have 89% of the contribution going to the owners, and the contribution is $308,000. Mike is now going to talk about who is an ideal candidate for a cash balance plan.
Thanks, Allison. Okay, what we're looking for are people that are tunning it, as we say, highly compensated employees. 200 would probably be a minimum. 300, 400,000 certainly would make them a better prospect for cash balance plans. Do never forget about skilled trade people like plumbers, heating and air conditioning folks. Again, it's not unusual for them to make as much as a physician. And then we talk about the ologists. pathologists, anesthesiologists, radiologists, etc. Across the nation, there are currently 11, or a year ago, there were 11,000 plan sponsors that had a profit-sharing contribution. Law firms many times are good candidates, as are venture capital and financial services. But the best candidates, whether it's the law firm or the financial services or the ologist, is a firm or a business that currently has a new comparability or cross-tested plan in place. When we first started learning about cash balance plans, I've been doing this for over 30 years. I was thinking, I assumed, which was incorrect, that it would be just a freestanding cash balance plan. But they really do work best with another new comp or cross-tested profit-sharing plan. And then we're looking for firms or businesses that have between 1 and 40 partners or shareholders. Shareholders work just as well as partners. Okay, here are 6 basic features that you need to know about cash balance plans. It's a different animal, but it falls in the qualified plan family. So just like a 401k, when someone separates from service in a cash balance plan, that person can either roll their account balance into an individual retirement account, or they can transfer it into the qualified plan of the successor employer. And what a lot of the decision makers like about cash balance plans is that there can be complete flexibility among the partners. They can actually have different amounts, as even Allison showed you on one of her earlier slides. And in this case, we could have 2 partners that are both age 50, and one of them may want to tax shelter an additional $100,000 of his or her income, and the other one may not want to participate. Typically, what you would, a more common scenario might be that partner 1 remains at age 50 and wants to contribute $100,000. Partner 2, age 30 or 35, just envision a younger physician, may not be able to contribute anything because of student loans and paying off medical equipment. But the point is, there's very much built into this program contribution flexibility. Okay, you can change. I talked about earlier the investment crediting rate, that it's got to be hardwired into the plan document. It's got to be written into the plan document. And that can be changed. But do keep in mind that this is not to be confused with a profit-sharing plan. And what are most business owners concerned about these days? Well, the ones that I talk to are concerned about volatility. And it could be volatility in the stock market. It could be volatility about the national economy, even the global economy. But I would submit to you it's volatility in their underlying industry that they're most concerned about. And so if the business cash flow decreases, what we recommend is, instead of amending the cash balance plan document, go ahead and reduce the 401k and the profit sharing allocation. And then if you do want to amend the plan, it can be done. The 3 years in parentheses is just a guideline. I assure you, you will not find that number anywhere in the Internal Revenue Code or the regulations. But what is critical is that you cannot amend it every year. There has to be, the code says that the plan must be permanent. And I think the IRS would come in and question the whole idea of permanence if the investment crediting rate is changed on an annual basis. You can freeze the plan. Now keep in mind that for most plan documents, virtually everyone that we've seen, a participant accrues or earns a benefit for the current year after they work 1,000 hours. So for your typical 40-hour-a-week participant, somewhere around mid-June is when they're going to hit their 1,000 hours, typically. And so even if you froze the plan, in July, you're still going to owe that participant a contribution up until the date of the freeze for that year. Okay, feature number 4 funding of the plan. Let's look back at the year 2010. Let's assume we have a calendar year taxpayer business, and we're going to also assume that it's a corporation or an LLC taxed as a corporation. The first funding deadline is up until the time they file their corporate taxes, 2.5 months after the end of their plan year. Now, anybody, and most of the attendees I'm sure know this, can get an automatic 6 months extension, so that for corporation, the latest funding deadline would be September the 15th. If the business entity was a partnership, you could, the first funding deadline would be April the 15th. The last funding deadline would be October the 15th. Now here's our observation though. For cash balance plans, most professional firms want to go ahead. They know what the obligation is going to be. It's written into their plan document. They have an idea of what everybody's compensation is going to be, so they're going to contribute to the plan on an ongoing basis out of immediate cash flow. Many family businesses do not want to do that. They many times will wait until, if it's a corporation, until they do their taxes on March the 15th, or after, a 6-month extension, or if they're a partnership, April the 15th through October the 15th if they get an extension. Unlike 401ks, typically when we have clients that want to make a profit sharing plan contribution throughout the year, we highly recommend they either just earmark it in the corporate checking account or set up a separate money market account, but don't contribute it into the plan year until after everything is known in terms of compensation and that they in fact do want to make a profit sharing allocation. Okay, feature number 5 is the minimum participation requirement. And the code section that deals with this is 401A26. That would be the numbers 401 and then lowercase a in parentheses and the number 26 in parentheses. And it's basically called the 50-40 rule. And so the plan must cover the lesser of 40% of the eligible participants. So if we had a group of 20 eligibles, it would have to cover at least 8, but only 8, or 50 employees. So if you play with the numbers, 125 eligible participants would be 50 employees. And a nice plan design feature is, let's suppose you had a very large medical group or a very large law firm with well in excess of 25 eligible participants. You could actually end up with a cash balance plan where the 50 employees covered would all be either partners or shareholders, and you would not have to include any of the non-partners or non-shareholders. A very interesting plan design. Okay, the last feature that I'm going to talk about is that the non-discrimination testing takes place primarily in the profit sharing plan. Allison did a very good job of walking you through those mechanics, and so this is virtually an identical slide that she went over. And so you can see under the profit sharing column that instead of 5% that we would normally have to put in for a cross-tested allocation, the gateway is up to 7.5% when you combine the cash balance plan with it. And going back to feature number 5, do keep in mind we would only have to cover 40% of this group of 12. So we could actually cover owners 1 and 2, and then if you shoot to the bottom, the 3 lowest paid employees, Sabaton, Perota, and Keebler, we could just have 5 people in this cash balance plan. Okay, now Allison is going to wrap up our webinar.
We at Pension Planning Solutions are very excited about cash balance plans, and we think that they are a great fit for certain companies. If you think that it might be a good fit for your company, please feel free to provide us with your census data, and we'll be happy to give you a complimentary cash balance plan analysis to see if it's something that might work for your company. If you'd like to do that, or if you just want to know more about cash balance plans, you might have some questions, or you want to learn in more detail how they work, feel free to email either Mike or myself at the email addresses that are listed on the screen. That concludes our conference for today on cash balance plans. Thank you very much for attending.
Thank you.